Thank you, everybody, for joining me here this evening on the big new beautiful bill and taxes and what are we going to do? And I'll reiterate what Don had said in that understand that everything that I'm going to talk about tonight does not necessarily apply to you, right? And so not everything here fits all of my businesses or my investments or whatever, but we're going to go through this just from a planning perspective because we've got just a bit of a little bit of a problem here, and that is that we don't know what the final bill is going to be. So, as far as the current or where we are right now, the House passed their version. You can see that very barely by one vote. And then it goes to the Senate for reconciliation. And that's where we are now. And so when you took the House bill at well over 1,000 pages, and then you add in another 500 and some pages of Senate amended text and different variations on the same theme, you'll see that we've got a lot of information together here on something that we don't know exactly how it's going to turn out. So, what I've done here tonight is that I've listed some of the key provisions that apply to us as individual taxpayers, along with some of us who may have businesses or nonprofits or other things, to be looking at what are these bills, the tax provision in these bills, what do they really say? What can we sort of count on at this point? Because we're in a kind of a weird situation from a tax perspective. And that is that all the tax bills and all the different provisions that were passed quite a long time ago at the very beginning of the first Trump administration, a lot of those provisions are expiring and they're going to be out as of December 31st of this year, which means that if nothing happened here, we would in effect have, or at least a lot of people would have in effect, a pretty large tax increase starting January 1 of 2026. And so what the House is trying to do and what the Senate is trying to do is figure out ways that we can advance some of these, maybe make them better, maybe take a little bit of the impact away. But what can we do so that when January 1 comes around this year, we have some sort of a tax law in place. Now, here's the major problems with the bill. So people have asked me, do I like this bill? And yeah, there's a lot of things in here I like. But the reason I don't like the bill is all because of this, that you can see that it adds a considerable amount of money here. The House version, a little over $3 trillion, Senate version closer to $4 trillion. And if we let all the tax changes expire, then you could see that this is how much money, excuse me, if we extended them all, this is how much money it would cost. So the Senate and the House are both looking at this and saying, wow, 4.6 trillion, we got to cut some of that out. Well, they didn't manage to cut out a whole heck of a lot. So again, if you hear me say anything negative about this bill, this is the problem. This is the screen that I would go back to and say, look, as long as the House and the Senate version are costing us money, meaning that they're taking the deficit now from 36 trillion or whatever it is up to 40 trillion, and then we have all the interest on that. That's where I find this to be unacceptable. So, with that, let's look at some of the provisions that we're going to have with respect to individuals. The the good thing here is that the tax brackets are staying the same. So yes, you'll see like the margins and the brackets, they'll go up every year because they're indexed for inflation. But what we're not seeing is any difference in these numbers. So obviously, one way to lower the cost of this particular tax bill would be to increase this 37% up to something else. That is definitely not on the table right now. Okay, so that's not going to happen. So I think we're going to look at the same tax bracket. So, if you made about the same money amount of money last year as you're going to make this year, you're going to be in roughly the same tax situation if you don't do anything else. In other words, if you don't have any investments, if you don't have any other businesses, if you don't have anything that's going to reduce your taxes. And that's where the last two bullet points come in. So we've got proposed changes to Schedule A, which is where you itemize all of your deductions. And so the real big difference, I think, between a lot of the changes here are going to be in the nuances here. And so how you play in sort of the trenches, not necessarily the black and white, but in the gray area, again, is going to make things a lot different as far as your tax results are concerned. So as far as the itemized deductions go, there's no changes as far as the house goes. And then you're going to see some of these no changes make permanent. Make permanent is a little bit different than when I don't have it. So in this case, the House is not going to make this permanent, meaning that coming up in 2028 or 2029, we've got to go through the same act again and figure out what do we want to do. The Senate wants to make it permanent. And by doing so, it pretty much gets into the situation of we know what the law is going to be. So it makes tax planning a little bit easier. The downside to it, though, is it gives out a little bit less flexibility. And so down the road, we're thinking, well, these changes are permanent here, and that doesn't mean permanent in the sense of it can never be changed. Just means that until it's changed, it's permanent. So as far as the miscellaneous itemized deductions and the mortgage interest, those stay. So as far as some of the miscellaneous deductions for legal fees, accounting fees, financial planning, safe deposit box, all these different itemized deductions that the first Trump bill took away are going to stay away. And I don't see these coming back anytime soon, at least, not for the next 4 years at least. The mortgage interest cap stays, so that's where you get into that. If you have a mortgage interest where your mortgage itself is $1 million or a couple $1 million, you're not going to get to deduct all of the mortgage interest. This slide here, though, shows where the really big difference is in Congress today. And this is one that I don't know exactly how it's going to play out because if you do anything else beside what the Senate wants to do, it's costing the government money. So here's what we're talking about with this SALT. So SALT is state and local taxes. Okay, state and local tax deduction that used to be unlimited. So if you paid $100,000 of property taxes on your mansion, that would be fully deductible. Or if you lived in a high tax state, let's say you made $1 million in California, you're paying over $100,000 in state income tax. All of that would be deductible until the 2017 Tax Act came in place. And they put this cap at $10,000. So whatever state and local income taxes or property taxes that you have, your personal residence or maybe a vacation property, $10,000 is the most you can claim. So if you have $100,000 there, the other 90,000 is disallowed, and you don't get to pick that up in future years. You just lose it. So the House, and here's where the House had a problem. Notice when I said at the beginning here that it was only passed by one vote. There are a lot of House members that are Republicans that are in high tax states, meaning Illinois, California, New York. And so what are we going to do there? Well, their constituents were really getting burned on this, right? And so the House said, no, we don't want to take this $10,000 cap anymore. We want to jack this up to 40,000. And then once your income then starts to get over this 500,000, and anytime you see Maggie here, what we're talking about is modified adjusted gross income, meaning not taxable income. So this is your gross income. So as long as you make, less than 500 grand, you got a $40,000 deduction. And once your income goes up to 600,000, you lose it completely. And if you're in between these two numbers, this 40,000 goes down towards the 10,000 amount. So what do you do here? Well, if you take the House version, that's going to increase the amount that this bill costs, and so something else is going to have to give way. So what I'm expecting here is some sort of a compromise between the two bills because the House isn't going to get this passed with the Senate cap in place. Or these representatives that are Republicans are going to have to go against what they've said publicly. So I don't know which one of those is going to happen, but either there's a prediction or they're going to a compromise, excuse me, on my prediction, or the Senate cap is going to keep the $10,000 amount there. I think we're going to see some compromise here, but it may not be until 2016 that looks like I got one too many zeros here too, excuse me. It won't be till 2026 that we're going to actually see some of these tax laws. And so this is going to give us a little bit of a planning opportunity here once we know the final version of this. So let's say that they do compromise and they make it 25,000. You can look then at your different tax bills that you may have and be able to figure out, well, do I want to take that in 2025 when this $10,000 cap is in place? Or do I want to wait and maybe not make a payment in December, but make it in January when a higher cap, 25,000, like I'm guessing, or potentially up to this 40,000, maybe the Senate will give in. I don't know, but we have a planning opportunity here. And this is one of the things that I think a lot of taxpayers miss the boat on is the bunching of personal expenses here. So that there's a lot of folks that don't have enough expenses every year to necessarily qualify to itemize. And so if you can take all of your medical expenses, or if you can take some of these taxes, especially if the $10,000 cap is removed, and put them all into one year, that year you have a much better chance of itemizing. And I think that is going to be a really key planning point here. So maybe you're thinking about making a $20,000 donation to your a religious affiliation or a hospital or a school or something, and you're thinking about making that at the end of this year. You should take a look at what the law is, and certainly we'll know by December. I'm expecting a bill, not what Trump says, to have it on my desk by July 4th. I don't see that happening. But if I said August 4th, I think that's a very realistic goal. So I think, sometime before we get into the fall, and certainly before the fourth quarter of this year begins, we're going to know how all this plays out. Now, before I move off to SALT, I want to talk about qualified trades or services in business here, a specified service business. So there's a lot of us out here that have a flow-through entity. Okay, so it may be an S corp, it may be a LLC that's taxed as an S corp, or a partnership, or a flow-through sole proprietorship, anything but a C corporation. There are differences between the House and the Senate as far as property taxes go and how they're going to be applied. Now, what do I mean by that? Well, the current law says that, let's say that I have a law practice, and that's a specified service, trade, or business. It is. It's written down, and just like a lot of you on this call that are accountants or real estate agents or consultants, I mean, a lot of us have service businesses where let's say that my law practice owns a building and it pays $20,000 in property taxes every single year. I can deduct that on my 1120S, in this case, an S corporation return. SALT doesn't apply. Well, the Senate and the House are now debating whether they're going to take this provision out. It'd be a big way to raise revenue. So if in doubt here, like if we don't know, what am I going to do here? I'm going to pay every single tax that I can in 2025 for my business. Every state tax, any local taxes, everything, pay it this year because I know it's deductible. Whereas next year it may not be, or it may be limited. So instead of getting $20,000, maybe I'd get 15 or 10. And so these are things that we have to look at sort of in the trenches, right? That this is where the game is going to be won or lost with the SALT deduction here. So who gets this deduction? Is it going to be the business, which is the way it is today, which is the way we want it to be? We meaning anybody that wants to pay less in tax, right? Because if the business gets it, it's unlimited. But if the individual has to pick it up, then that goes into the cap, whether that's $10,000 or 40,000 or something else. So if you find yourself in this position, and again, we'll know this in the next month or so, as to if the business no longer gets these deductions, then we're going to start looking at, well, maybe then we may need to start looking at a C corporation as opposed to an S, because the C corp would get it and the flow through wouldn't. And so all of this stuff, I mean, I was reading some of these provisions multiple times, and I'm sitting there going, I don't have a clue what this means. I really don't. And I understand this provision, I understand this section, I understand this part of the tax code. All of these tax laws that we're talking about are not old. Like SALT didn't exist before January 1 of 2018. It didn't even exist. And so, this is all relatively new stuff. And it seems like, I had a pretty good grasp on it until I start reading a lot of the stuff. So I was reading some of the analysis, and KPMG, a big accounting firm, put out this statement, and I read some of their differences here in coming up with this presentation, but this made me feel a little bit better. So KPMG says, as with the House bill, so we're talking about the Senate bill here now, but as with the House bill, it is unclear from the statutory language what this provision is trying to accomplish. The Senate Finance Committee section by section explanations do not provide further clarity. So I was thinking, I just don't understand this. But then they put out this saying, we don't know what this says. So if some of the stuff, that I'm talking about here is a little bit confusing, understand that it's confusing to all of us. And what we're trying to do is figure out the best way that we can plan to make the most of whatever it is that Congress is going to give us. All right, a couple of other personal deductions here that are brand new. The House put this in, and this is not permanent. So you see this through 2028. So this is for people who don't itemize. And the same thing with the Senate. So if you take the standard deduction, which I believe is going to be 15,000 for single people and 30,000 for married couples who file joint. So let's say if you add up all your deductions and you're married and it comes out to 25,000, you're better off to take the 30,000 deduction there, right, as the standard deduction. In that case, you get this extra charitable deduction. And in a case like this 300 is for married, half is for single, and then the same thing with the Senate. So I think we're going to see a compromise here of something. I think they're going to split it right down the middle. But whatever it is, even if it's only 300 or even if it's up to 2,000, know that even if you don't itemize your deductions and you claim that standard deduction every single year, you're going to get a little bit of a bump up here as far as any charitable deductions go. And the same thing with this automobile interest. So we don't know how this is going to apply, but if you asked me today, so I don't know this slide, I've never seen this slide, but if you ask me today, can I deduct my automobile, the interest that I pay on the loan? My answer is no, you can't, but your business may be able to, right? If it's in your business, you can do it, but that's a personal deduction and that's not going to work. And the House said, wait, let's change that. Let's say that you can get up to a $10,000 deduction, even if you don't itemize. Okay, so you don't even need to itemize your deduction. If you buy a car this year, new or used or anything else, as long as it's made in the USA. Okay, so you can't go out and buy yourself your fancy German car and get this deduction. But if you buy a car that's made in the USA, which obviously if you're going to finance it and you're going to have interest charges, you better find that out in advance, right? Don't buy the car until you know it qualifies. But then the House would phase this out. And so once your income got up to 100K, doubled if you're married, then it phases out. The Senate doesn't have that phase out, but and they have a $10,000 deduction. So both of them are in agreement here, but the Senate applies only to new cars, where it applies to either one. So I think what we're going to see here is the $10,000 deduction seems pretty well set. And if you're going to buy a car, you might want to wait now until we know what this law is, especially if you're not going to deduct the interest for business purposes. If you're not going to finance, it doesn't really matter. But if you've got this automobile interest, we need to know, is it going to be for a new car, which is where I think it's going to go to encourage manufacturing in the US. And there probably will be an income cap here. And so that's another one of these guys where there's so many different phase outs for all kinds of different deductions. We're just going to probably add this one to the list. So this is an interesting one because it doesn't exist today. And this one also that I've thrown up here doesn't exist today either. So this is a brand new one. And so back, I guess maybe a year or so ago when the campaigns were going last summer, one of Trump's statements was, I don't want, or I think tip income and Social Security and overtime shouldn't be taxed, okay, as a way to pick up a little bit of a voting block there, right? And so what did the House do? Well, the House said, cool, if you make any tip income, so let's say I make 50,000 a year and I make 10 grand in tips, I can deduct that $10,000 in tips from my overall gross income. So I don't have to pay tax on it. And the Senate says exactly the same thing. If you got the tip income, you can deduct it from your gross income. Okay, all well and good. Differences here, though, are that we've got phase outs amount. And so the phase out amounts a little bit lower on the Senate side. So what does that mean? Well, it means that it won't cost the government quite as much money because if you make 150,000, you start losing it if you're a single person, whereas the House, it's 160,000. So it's not a big difference here, but I think you're going to see some sort of an income cap. And this cap here, I've put the Senate version as where I think we're going to fall. I could also see this cap even coming down. And so it's 150, 300 right now. I could see that coming down to 100, 200, like some of the other provisions, just because both the House and the Senate are going to have to figure out how much is this going to cost. And that's going to be the real big limiting factor, right? And I think that's true for most Congresses. If you go back on it and you say to a fully Democratic Congress, yeah, we don't care about the cost. Just give the taxpayers anything. They're going to come up with an incredible bill. And the same thing with the Republicans. If you say, don't worry about the cost, just do whatever you want, we're going to come back with all these provisions that we love, right? Because it's a short term issue for the politicians where the debt becomes a long term, very long term issue at the way it's going. So, tip income, if you receive tips, this is a good deal as far as your personal taxes go. Same thing with OT. So, if you've got some overtime income, both the House and the Senate, again, just like the tip income, deducted from your gross income. We've got another cap in the Senate. So the cap here says, yeah, you can make $1 million of overtime, but you can only deduct 25,000. And then again, at the different phase outs here. So the 160, 150, again, I think you're going to see the Senate version here definitely capped at something so that the government can have some idea what this is going to cost. And then the phase outs so that not everybody is going to be able to take this. Obviously, another brand new one. Just look at the name here, right? Where we get our Trump savings accounts coming in. This did not exist before. And for whatever reason here, the Senate and the House came pretty close to agreeing on pretty much everything here. So if you have a baby born sometime between 24 and 28, $1,000 that the government will put into this account. No distributions before age 18. So it's kind of like an education savings account, um, but you can't take it out before age 18. Now, I don't know what they're going to do as far as hardship provisions or anything else. But at age 30, you can take it out for any purpose and 5 grand a year. So if let's say I have a new child born next month, government would kick in a grand. I can put in 5 grand. Okay, so now we've got $6,000 in this account, and all of the amounts that are put in there, the earnings are tax deferred. So here's the really, I mean, a really nice way of looking at it, right? Your earnings are tax deferred, and this is a little bit different than an education savings account because when we look at like an education savings account or a health savings account, if you take the money out for qualified purposes, so let's say that I have a hospital bill and I've got to pay 5 grand of my deductible, I pull that out of my HSA, that's not taxable to me. This savings account is going to be different. And so if you have a qualified withdrawal and you take it out, you're taxed at long-term capital gains rates, okay, which has always been more favorable than ordinary income. If it's non-qualified, then it's taxed as ordinary income. So basically what you've done there is you've gotten all of the earnings tax deferred, but when you pull them out, how are they going to be taxed? Is it going to be 15% as a long-term capital gain, or is it going to be up to 37% as ordinary income? So the big question then obviously is what's qualified? Makes a big difference if it's qualified or non-qualified, right? So what does qualified mean? Well, qualified is for your a first house to put money down on it, get your down payment going, for your education, or for capital to start a new business. When I was starting to type this in, I also had healthcare expenses in there because those are almost always included, but they're not included here. So if you buy it for a down payment, if you buy it to pay off some of your college, or if you buy it, or if you withdraw the money to start a new business, get your business going, we get capital gains. Otherwise, taxed at whatever your bracket is. Okay, I mentioned the standard deduction. What the House is going to do is raise this up and make it through 2028. And then the Senate, same exact thing. So when I said it was 15,000 and 30,000, you can see that that's going to go up by a little bit of money there, right? Another grand and 2 grand. The only difference here is that the Senate would make this permanent and then just index it to inflation, where the House would renegotiate this when Trump leaves office. So that's why you see a lot of these 2028 amounts there, because this is something that he wanted done. Again, making it permanent makes it a little bit more costly. I don't know if we're going to see this one get the permanence. So I'm thinking that the House version is going to control. But this is something that we need to be aware of, right? Because again, if we go back to the bunching, where if we know that next year I'm married and I've got this $32,000 number that I've got to get over before I can itemize, well, man, I'm going to hold off then. And maybe not make any big charitable donations this year, or maybe some of that elective medical procedures I'll do next year and put it all into January instead of December. So this particular slide, I think, is going to become a lot more valuable to us in the fourth quarter. I mean, right now it's like, we don't really know what these numbers are. When we get to the fourth quarter, we're going to know this is what the standard deduction is in 2025. This is what it goes to in 2026. Which way do you want to go here? Now, for some of us, I mean, maybe we always itemize or we always take the standard. But if you're one of those where it can make a big difference year by year, depending on what you do that year, we want to know what this law is. All right, we've got the child tax credit as well. Currently 2 grand a year. Senate would bump it up a little bit. Excuse me, the Senate bumps it up a little bit. House bumps it up a little bit more. I think what we're going to see is the House version here again, that we're going to see it go up to 2,500. Very favorable provisions to anybody that's in the lower half of the income. These, we're not talking about tax brackets at the very bottom. We're talking about the lower 50% of taxpayers can make this child tax credit work. Same thing with the senior bonus, age 65 plus. House is going to give us this little bonus here of a deduction. Senate would give us a little bit more of one. House has a phase out, the Senate doesn't. So I think you're going to see the House version come in. And so if your income is under these amounts, then you can get this extra tax deduction here. The both of the House and the Senate, what they did here is they were going to make it a part of the standard deduction, and they just made it into a separate tax deduction. So kind of works out the same way. No changes as far as Social Security. The reason I put this in here is because Trump wanted to make it income tax free, and neither the House nor the Senate agreed with that. So you're going to see whatever the Social Security benefits are that you get today, and whatever those tax results are, that's going to be what they're going to be next year. Estate tax, $15 million exemption, and you'd be able to double that if you're married and you have some estate planning. So you could go up to 30 million if again with proper planning. Senate is going to do the 15 million and make it permanent. I think what they're going to end up doing is using that 15 million exemption and then adjusting it annually for inflation. So these are, some of the things that, estate tax purposes, maybe we start looking at more gifts now because with the gifting here, and that's going to stay at where it is today. So we don't have any adjustments there, but maybe we start looking at ways that the estate tax and the gift tax and what we do with our assets and how we leave them to our heirs or whoever we want to leave these assets to, when is the best time to get them there? Is it better through our life via gifts or after our life via an estate? All right, one more slide here for individuals, and this is one that the op zones, as we call them here, our little op in the middle here. So it's our qualified opportunity zones. This was a big part of the last tax bill. The House is going to extend this through 2023 and have another round of opportunity zones. So if this is something where you were looking to invest before, again, this is how this plays out, is going to give us a real nice opportunity to be able to avoid some capital gains, defer some capital gains, and basically change some of our investment mixes. And I know that I think Don and I we've done a webinar on the opportunity zones a while ago, but the laws are going to be very similar there. So this is something that we want to watch. I mean, I don't know what's going to happen, but if you want to look at investing into some of the opportunity zones, some of the places where it takes a tax advantaged sort of investment to get people to do it, right? Maybe in economically disadvantaged places. But this is a real nice tax planning strategy once we see if it's going to be new opportunity zones every 10 years or every 5 years or next year, but it gives us more planning. Okay, grab a quick drink of water here before I talk just a little bit about some of the tax changes for businesses. And these are huge as far as anybody with a flow through business. Whether, again, I'm not talking about a C corp where your taxes stay at the corporate level, right? So these are all your big Fortune 500 companies, all your NASDAQ companies, whatever. Microsoft, right? Their income comes in, they pay all their taxes, they pay all their expenses, whatever's left is taxed at whatever the percentage is, currently 21%. So now we have to look at how did some of these changes now come about for other businesses, tax rates, and this big QBI, qualified business income. This is a major changes along with the depreciation. And these are the two areas that I really want to just talk about here in the final part of the presentation tonight. So do we extend these tax cuts? from 2017, or do we let them go away? Or do we extend them and make them permanent? And so that's what Congress has to decide what they're going to do. And this is going to be the big reconciliation component of the next probably 3 or 4 weeks. So this QBI, so this guy did not exist in Section 199A, that I'm going to underline here, did not exist before December of 2017. And what this law said was that if you have a flow through entity, so anything besides a C Corp, so you have sole proprietorship, and let's say you took in $200,000 and you spent 100,000. So you've got this $100,000 net profit. The current law says you can get a deduction of up to 20%. So in that case, I could say, well, my net profit was 100 grand, 20% of that is 20,000. And so therefore I subtract it and I pay tax on 80,000. Now, what the House would do is change this 20% number to 23%. Where that came from, who knows? Senate says, no, let's just leave this alone, but make it permanent, meaning that if Congress changes, and usually it does over periods of time, you get different mixes of different political parties in there. If we make this permanent, we don't have to negotiate that again in 4 years or 6 years or 8 years or whatever. So what I think we're going to see is this 20% that we've all been relying upon, all of us tax nerds and tax geeks that have been looking at the tax planning of this. And, I think, I don't know how many hours I've devoted in videos. I'm trying to think. I mean, we had so many different videos of this. When you look at the 199A, with Toby Mathis and I do a tax program, and what we do is we cover a lot of these changes. And I was just thinking that we must have 10 or 20 hours of videos on Section 199A. Now, of course, we're going to have to update that a little bit again next month when we find out what this is. But this is one of the biggest tax law benefits to businesses out there today. This is a major, major benefit, and it's the reason why, given that the C corporations pay tax at a flat 30 or 21%, that if that was the rule where you had a 21% rate as a C corp, but this 20% deduction didn't exist, well, we'd be telling all of our S corps to convert to a C corp, right? To just basically throw away the S corp election, to reject it, and at that point become a C corp because you're going to pay a lot less tax. But this 20% was sort of the equalizer. And that's what we're going to see here, I think, as far as where that goes. And I think they will make it permanent. It's something that, in Congress, I mean, you're never going to get 100 senators, it seems like, to agree on just about anything. But this is one of them where if this was a sole vote, right, that we didn't have all these other provisions, but we just said up or down vote, yes or no, do we want to make Section 199A a 20% deduction, not 23, and make it permanent? And I think you'd get 90 some Senate votes. I think you'd have Democrats that were voting for this too. Although, again, the way things are in Washington, I mean, that's probably a bold statement that who knows what they would do. But anyways, QBI is huge. The other part of the tax bill that is going to be extended here, notice unchanged, unchanged. And this is a part that I didn't like from the old bill, but they had to put it in there for revenue purposes, and I think it's going to stay. And so what does this mean? C corporation loss limits. C corporations, and here's my prediction because this is what the law is now. So I guess not really much of a prediction. I'll cross that out. I don't think I deserve to say prediction here. But anyways, C corp net operating loss, that's this NOL guy, to 80% of taxable income in any given year. You can't carry it back, but you can carry it forward as long as possible. And they're going to make this permanent. So what does all this really mean? And that's what the little example here, because it's kind of a hard way to decide or to be able to show how this plays out. So in 2024, I took in 100 grand in my C Corp. Okay. 2024, last year. I spent 150. And so I've got this net income of negative $50,000. No losses coming forward. Okay. So that's zero. Obviously, I have a loss. So I have no taxable income. And so 21% of nothing is still nothing. Right. So everybody understands 2024. The issue here then becomes this. We've got this $50,000 loss carry forward because we only had to zero out 100 grand of income. So we only had to use 100,000 of expenses. This 50,000 that we didn't use is called a net operating loss carry forward. Okay, we can't take it back. So in prior years, certainly back, if we go back about 10 years ago, we could have taken this 50,000 back to maybe 2021 or 2022 and gotten a refund. Can't do that anymore. Okay, so that's a big X. No, that doesn't work. So we carry it forward. So this year, we're on December 31st, year ends. I took in a nice amount of money and I spent the exact same thing as I did last year. And so I've got this $50,000 net profit, right? So 200,000 minus the 150, I got 50,000, but I know that I've got this $50,000 of loss. So it'll just zero out and I won't pay tax. And that's the part that gets people because that's not what the law is anymore. What the law says is that you've got a taxable income and you've got this loss carry forward. So you can only use 80% of your taxable income or $40,000 of loss here. So what does that mean? Well, I can only use 40, so 10 goes into next year. And the 40 that I can use now says instead of zeroing out my income, I've got to pay tax on 10 grand at 21%. So this is something that the tax law, this did not exist in 2016 and 2017, but 2018 as far as what the new law is going to be. All right, research and development costs, the R&D stuff, fully expense this. So what the 20% limitation and you get into some sort of depreciation after that or whatever, why don't you just write the whole thing off this year? And the Senate said, yeah, we agree with that and let's make it permanent. And I think that you're going to see this fully expensed. Not sure if it's going to be permanent or not, but certainly for the next 4 years, your R&D expenses are not going to be limited to this 20%. Same thing with machinery and equipment. And so, if I go back to the last slide here, well, my law practice doesn't have R&D expenses. And a lot of businesses don't. Certainly some do, but a lot of them don't. Whereas if I go to this one, the machinery and equipment, we all have these expenses. I mean, I'm sure there's somebody here that has a business that doesn't have a computer or printers or furniture or other things. Today, what are we looking at? Well, we've got to figure out, is it section 179? Is it bonus depreciation? There's or 10 or what's all this stuff? Well, the House says, you know what, just expense it. Kind of make bonus depreciation, bring it into play here. And the Senate says, yeah, we agree with you, and we're going to make it permanent. I don't think they're going to be able to make it permanent here, but I think we're going to fully expense it. And so that's this bonus depreciation where the House says, very cool, you get 100% through 2028. And I think this is what the law is going to be. And the good part about this is that the old law started phasing down the bonus depreciation. So it's kind of hard to see down here at the bottom with this little ribbon, but in 2022 it was 100%. And then it started getting chopped down 80 by 20%, 80, 60, 40, 20, and then it was going to go down to zero here. This whole thing has been eliminated. Okay, as long as the final version of the law is one of these top two, which I think it's going to be, again, allowing businesses and certainly small businesses to be able to expense these asset purchases. I think this is a really nice provision, and we get at least 4 years if we don't make it permanent. Section 179, may or may not be as important now with the bonus depreciation, but there are different reasons why, from a planning perspective, somebody may claim Section 179 and not bonus. So I kept this in here. Senate version is the same as the House. I think the House version is going to pass. And basically, talking about here is saying you can Section 179 fully expense all of these purchases, and we're going to double it. So if your business spends anything up to 2.5 mil on computers, equipment, and anything else, like equipment wise, you get to fully expense it. And there's different strategies as to why you may want to use Section 179 and why you may want to use bonus depreciation, especially if you have a loss. Because we go back to the bonus guy here, this can increase a loss. So if you're zeroed out and you got 20,000 a bonus, you can end up with a $20,000 loss. Whereas Section 179 does not allow that, the loss, they allow it to be carried forward. So different planning, but the bottom line here is understand whatever expenses you have, as long as you're less than 4 million of net or of gross receipts, you're in good shape here. And if you are over that, well, just go with bonus then. So I think very, very favorable provisions in these bills. The other thing, and this is something that people don't talk about very much as far as the planning goes, and I've never understood it. Because with a C Corp, okay, so if you've got any of the other entities, forget this slide. Qualified small business stock only applies to a C Corp. But if you hold that, so new C Corp starts off today, as long as the value of that company today is less than 50 million, which of course it's going to be, but let's say I just put in $10,000 into a small C Corp and I hold it for 5 years. When I sell that stock, I pay no tax. And so a lot of the planners out there, they don't understand the qualified small business stock. But if you can just hold it for 5 years, most of these C corps are going to be way less than 50 million at the time the stock is issued. You can make a whole lot of money and be eligible for this great exclusion. So here's what's going to, I think, happen here as far as the stock goes, and this is what the Senate has done. This was not in the House, and so it's going to be hard for me to make any predictions because if you go back or if I go forward here, it's not applicable with the House. The Senate instead of that 5 year rule, changes it to 3, and instead of 50 million, it jumps it up to 75. Those are the differences here. So I think what you may end up seeing is different exclusions depending on when the stock was acquired. This obviously adds a lot more complexity to it, but this is what's in the Senate bill. So depending on when you acquired it is going to determine whether you get the full 100% exclusion on your capital gains, or maybe it goes down to 50%. So instead of paying tax on 100,000 of capital gains, maybe you pay tax on 50,000. So again, this is something we want to look at for our C Corp shareholders because this is one of the best provisions in the current code. A couple of other last minute ones here. Just want to point this out. Nothing in the House bill had anything on the Forms 1099 and K1s, but as far as the Senate, so these 1099 miscellaneous and NEC is non-employee compensation. Currently, if you pay me, let's say you pay me $700 and I'm an independent contractor, you've got to give me a 1099 because it's more than 600. In the Senate, this amount would go to 2 grand. And then as far as K1 returns, so this is a lot of online business. Currently, you get a K1 if you're more than $600 of sales. This would go to 20 grand and at least 600 transactions. So know that the Form 1099s may be changing as far as who has to issue them and under what circumstances. Nonprofits, pretty good as far as the tax treatment goes. I'm not going to get into some of the college endowments here, but as you can probably know, Trump and Harvard and some of the other universities are having a big sort of a public spat, I would say. And currently, their endowments are taxed at 1.25%. The Senate and the House both raise these, and I think you're going to see this go up somewhere around the Senate's 8%. But this isn't going to affect any of us unless you happen to be on Harvard's board. What could end up happening, though, and could affect us is the private foundations. And so the House wants to take this current excise tax that the Senate wants to leave in place, and they want to up it to 10%. This would change the taxation of private foundations quite a bit. And so depending on how this works and how we see this compromise somewhere between 1.5 and 10%, somewhere in that range, will then determine how we go about the uh, the private foundations and do we want to set these up? All right. So that's kind of the bill in sort of in a nutshell. Again, I'm looking at over 1,000 pages and putting that into a 45-minute PowerPoint. But I think you can see some of the winners and the losers here. Notice I said nothing about EVs, so nothing about tax credits for electric vehicles. Those are going to go away at the end of this year. So if you're going to buy an EV, do it before the end of the year. Medicaid, obviously, really big one as far as paying for some of these tax bills. Again, Medicaid having a big reduction, having a big increase in the work requirement, and then cutting the food aid by what about $250 billion. A lot of health insurance will be eliminated. We're seeing this in Colorado with some of the public lands. Going to be sold to pay for some of this. Public debt, again, the reason I don't like this bill, because the public debt is doing this with the bill. Really, any of the clean energy. So a lot of the rental properties, or if you've got solar panels or whatever, we need to start looking at the clean energy because these are going to go away. So we have a little bit of playtime here until, maybe a couple more years, but they're going to go away. And then lower income taxpayers. This bill is set up for businesses and for higher earning taxpayers. That's just the way it is. Now, whether you think that's a good thing or a bad thing is a political discussion, right? And that's something where I don't go anywhere near that. Doesn't matter to me what I think or what you think about the bill, right? It only matters what the people that are voting on it is. So who wins? Well, so higher income, the more you make, the better the provisions become. Flow through entities. Okay, we love this 199A, even if it stays at 20%. C corps, because they're at 21%. There's been no talk of going to 25 or 30 or some other number. 21% stays. But the complexity. So of course, tax attorneys, CPAs, enrolled agents, anybody that's doing tax planning is going to win. And they're going to make more money, right? Because this stuff is complicated. So where you can see the difference in the political structure here, as far as who gets the tax cuts and who gets the benefits, the red here is the Republican bill from 2017, which is what we're voting on now to extend it or not. And you can see as the income gets higher, the red kind of goes up. And this is what the American Rescue Plan did. And you can see exact opposite of what the Republican plan does. So again, depending on your politics will depend on whether you like the blue one or the red one better, or whatever color we're going to get in the next month with the changes. So, anyways, I'm going to leave you with this quote from William Buckley saying, I'd like to electrocute everyone who uses the word fair in connection with income tax policies. Income taxes are not fair, they never have been, and they're not going to be. And so it just is a question of, does this tax bill fit me better than some other bill? Yeah, maybe it does. Maybe it doesn't. But as far as where we are today, I think we've got enough evidence here of where the bill is going to know that we can now do some planning as we get into the second half of the year, July 1st, right around the corner. So, anyways, with that, I'm going to turn it back over to my good friend Don Pendleton, and see if we have any questions or kind of where we are with everything. So thank you.
All right. Scott, let's cut your screen. Stop sharing. And what happened is we had internet was cutting out, and so we chose to hide you from screen. So let's share your video again, but let's unshare your screen if that's okay.
Okay, you want to unshare it or share it?
Let's turn off your video. Or I'm sorry,
Okay,
your
yeah,
yep, there
I'm
we
off.
go.
All
So
right,
it's just
thanks.
you and I talking. Okay.
There we go.
Okay, so let's start answering some of the questions. Are the costs, and I'm not sure, are the costs of the bill yearly costs or cumulative costs?
They're cumulative costs without interest. So it's not 3 trillion every year, it's 3 trillion over 10 years.
Okay, okay.
Hmm. Which
Three
makes it
twelve
better, I
trillion
guess,
for
right?
10. Okay, well, that's
Yeah.
better.
Yeah,
While
better.
the
We're
salt
getting there.
deduction may cost more money if changed, are there a lot of Republicans from states where the constituents don't get to claim more? As a result, it might not pass. I think you
Yeah,
answered that.
I did answer it. Yeah, for sure. The California and New York Republican House members don't like that cap. And it's pretty obvious, right? All their constituents are paying more than 10 grand in New California with state and local taxes. Makes sense.
Yeah, and in any state that has high property taxes or high income taxes, yeah, that's
It's it,
exactly
it's a
who we're talking to.
it's a big squeeze. I mean, it's a big squeeze here. Think even for Colorado, which is not a high tax state, but we have a 4.5% income tax, right? So if I make $200,000 a year, that's 9,000 that I'm paying to Colorado every single year. And so if my property taxes are any more than $1,000, I lose. And I think that's
Right.
what they're trying to get at. Not necessarily to allow, Warren Buffett to get a tax break, but maybe people like us that are, not necessarily the lowest of the low income, but we're also not, in the Bill Gates category either.
Okay, so when do the changes become final? Well, it's got to pass the Senate, and then it's got to come back to the House for a final bill, right? So
Right.
are
And
we
then
looking
I,
December, or what are we looking?
yeah, I mean, I think you got two questions here, really, is like, when is it going to get to Trump's desk? Which again, he said July 4th. That isn't going to happen, I don't think. But let's say it gets there in August sometime and Trump signs it. Then you have to look at some of the provisions. Are they going to be retroactive or not? So you could have some of the provisions start on January 1 of 2025. You could have some of the provisions start on, let's say, August 10th of 2025, if that's the date he happens to sign it. Or some of them will go into effect on January 1 of 2026. So we're going to have to watch the provisions, not just necessarily when Trump signs the bill, but when do those specific provisions go in? Because it can make things really complicated when you get split years. So I don't know what they're going to do about that.
Okay, Bob is saying he's ready to sell his personal residence. He's aware of the 121 exclusion, but he's got a bigger gain than that. He knows that he could maybe rent out the house for a year or so and 1031 exchange it. Any other recommendations to avoid the capital gains on your personal residence?
Yeah, personal residence is always tough, right? I mean, if you the 121 exclusion basically says, look, if you live in it for 2 years and you own it for 2 years of the 5 years before the sale, $250,000 of capital gains, no tax, and double that if you're married, right? For a
Right.
500,000. So it's a really nice uh, tax benefit. But let's say, you're like Bob here that let's say he has $1 million capital gain and he's married. So he's going to pay tax on $500,000 at probably 20% or so, because he's probably in a high income category, or he will be with this capital gain. So then you can start looking at, yeah, you could do the potential like kind exchange, the 1031 exchange by converting the personal residence into a rental property, but you've still got the same problem down the road when you sell it. And so you really have to look at, do I want to just take the 121 exclusion and take the capital gains hit? Maybe I'm older and I'm not maybe going to live that much longer, and so it would be better if my kids inherited the property rather than me sell it outright. So maybe some estate planning or gifting comes in. But really, I think I don't know, Don, unless you have a different idea as to how best to avoid those personal residence taxes. It can be tough.
If you're planning on selling the house, you are somewhat limited. If you're going to live there, obviously but though, but you mentioned that you could change it to a rental property, um, and then 1031 exchange it. And so what I've seen a lot of people do is 1031, 1031, 1031, and then do a charitable remainder trust, or they go into something like mineral rights, where now at least it's passive. But other than that, I don't know of any other ways.
It's really difficult, and I think the big thing, if you are going to go the route of, oh, I'm going to sell it, I'm going to take my 121 exclusion, but I've got a tax bill on top of that. What you really need to do is go back and make sure that your basis is correct, and that's the really hard part. Where a couple years ago, my mom sold her house that she had been in for 50 years. And we look at the sales document when they bought it back in the early 70s, and it was like 30 some $1,000, right? And but what happened in those 50 years? Well, they put new roofs on the property. They put they did this to the backyard. They got a gazebo now. They put whatever, a pool in,
Sure.
whatever, all these different changes that you have, you can add those to the basis to reduce your capital gains. So if we know we're going to get hit with a tax, which if you sell it here, sounds like you will, then let's try to nickel and dime the basis, go back through all of the personal records, finances, bank statements, anything, and try to put it towards the house.
Okay, great. Gene had noted that the cars, do they have to be made in America or assembled in America? And the House bill says full assemble must be here, or is it final assemble, or is that still being debated, or what's your opinion on that?
Yeah, that is being debated right now, and I think you're going to see. I mean, basically, right? If you look at the politician part of this, Trump wants to say, "Look, yeah, you don't have to pay tax on this anymore, or whatever." And the devil's going to be in the details here, right? As far as how that goes, I think what you're going to see is to limit the economic impacts of this, that the final assembly plus there's going to be some sort of percentages of how much of the car before final assembly has to be manufactured in the United States. Once we know those rules, they'll put out a list then. So we'll be able to see
Sure.
that, oh, this Subaru qualifies, but this Honda doesn't, or whatever it happens to be. And then you can make your decisions based on that. So don't do anything I mean, unless you have to buy a car tomorrow, but if you're thinking about buying one in the next few months, hold off and then let's see how this plays out, because it could be, a $10,000 deduction is, that could be worth what, 3,500 bucks if you're in the higher brackets. So it's a lot of money.
Sure. Great. Great answer. Thank you. Scott, please explain opportunity zones and which investments fall under them.
Well,
And simply, like within 20 minutes. What? It's a
how
complicated
about if I
issue.
do like, yeah, let me do like a 1 minute or 20 seconds.
Okay,
And
there
then
we go.
I think, Don, you and I have done, there's probably a presentation in your video library on qualified opportunity zones, because
Right.
they're a really nice way to be able to get out of certain investments with capital gains and not have to pay tax. So in Denver, we have an airport, right? Big Denver International Airport. Let's say that right around that airport, nobody wants to build right next to it because of the noise or whatever it happens to be. So nobody wants to build. The government then can say this area around Denver International Airport is an opportunity zone. And anybody that invests here, because nobody wants to, can get these tax benefits. So maybe the guy, his name Bob, that sold his house, maybe he can take those capital gains proceeds and invest it into an opportunity zone and therefore avoid some of the tax. I don't know if he can do that because the opportunity zone stuff is still being negotiated. But the point is that you can take capital gains that you would pay tax on and invest it in an economically distressed area that the government wants to encourage investment. And anytime the government wants to encourage something, they either give you a tax credit or they reduce the tax bill. And here they're reducing your tax bill.
Yeah, and so opportunity zones, almost every city, state has places where they're trying to encourage development. I remember Mississippi right after some of the big hurricanes. They wanted to encourage you to build, and so they said, "Look, you hold it for 10 years, and you don't have to pay capital gains taxes." Is that pretty much it?
Yeah, it's the same
Yeah.
thing, you know. Yeah, and we saw that with Hurricane Katrina and the Go Zone
Yep.
and all these other things. I mean, every president, Democrat, Republican, doesn't really matter. In 4 years, good things happen and bad things happen. And if you want to encourage investment, like I said, Go Zone was a really nice go with Gulf opportunity, but Go Zone with nice tax credits. Same thing here, where yeah, let's get money into places in, your home state of Utah or mine in Colorado or whatever that, they're just not that attractive investments without some sort of incentive from the government.
You mentioned solar and clean energy credits are probably going to phase out at least as long as Trump's in office.
Yeah, yeah, I think those are definitely gonna go away. It was something that right after this came out with the big public blow up, I guess, between Mr. Musk and Mr. Trump, right? But that was a big part of the big bill was, I mean, Musk didn't like the fact that it increased the debt so much, and that's what I didn't like. But he's also
Sure.
looking at this like, okay, the EV credits go away. Well, that doesn't do too much for my Tesla company. So
Right.
he didn't like that as well. So I think those are gonna come and go kind of depending on whether you have sort of a quote unquote a green president that wants to go in that direction, or if you have a president like we have today who's going in a different direction. So that those are going to be political decisions, but again, that's something I'd be looking at if I was going to throw solar panels on my personal residence. I'd be watching this real closely as to when the cutoff is, because it may cut it a lot sooner than 2026. The same thing
Yeah.
with some of the rental properties where you make those, maybe you modify them for disabled access or some of these other credits that we see that are really favorable with rental properties. They may also go away as well. So that's the one area I'm really watching because I think, it's not that big sexy sizzle that they can go to the press with, but it really is going to make a big difference in how a lot of us and a lot of us on this call tonight are going to go forward with their taxes.
Got it. Okay. Thank you. Um, if we start a C Corp with contractual agreement with a 501c3, does the corporation need to have employees in 2025? Is there a Q3 start for both C and nonprofit? I don't
Um,
understand the question. Maybe you do.
yeah, I think I do. The second part of the question is,
Okay.
can we start these things at the beginning of the third quarter, I think, and in the middle of the year? And the answer is yes. So you can start your nonprofit or any business any one of the 365 days a year. My guess is that you could probably file a corporation on Christmas Day, online. I don't know. I've never tried it, but you probably could. So yes, you can start those. And the issue with employees is, no, you don't have to. You can have no employees in 2025 for the C corp or the nonprofit, or 26. You could do that. It depends on the business. Do you have people, workers that are working for the business and, how are they being compensated for it? And when you have a C corporation, I mean, you can compensate them with stock, I guess, if you're not going to compensate them with wages or a salary. But no, I mean, the business never has to have employees until they're needed so that, you don't have to, let's say my law practice, when I started it in Denver, I started that in January of 95, but I don't think I took a salary until probably later in the year when I built up enough money in the account. So it's like I don't have to pay myself if I'm not making anything.
Yeah. And Doreen, she's asking if opportunity zones are based on geographic. Yes, and in fact, they're very specific. On the north side of this street is an opportunity zone, on the south side is not. Yeah, it's very specific. And so your state will know where the opportunity zones are. In fact, there's maps all over the United States that will do that. Okay, Gene is saying the only one who wins in this are the tax planners. And Gene, you're absolutely right. The more complicated the tax code gets, tax planners, CPAs, enrolled agents are the ones that benefit from that because we need their services. A flat tax would kill most tax attorneys, CPAs. If
Yeah,
make it
yeah,
easy for the rest of us, but it would put them out of business. Your
yeah.
thoughts?
Absolutely. I think you're spot on that one, Don. I mean, and it's going to create so much complexity. Because they're adding to what was already a complex document. And, I mentioned before where, Toby Mathis and I have videos to do on this stuff. I'll bet that we do at least another 8 to 10 hours of video sometime in the next couple months on this. And just to tell you, that's how much complexity there is. And of course, we bring different perspectives. So, Toby has his 5 ideas, I have my 5 ideas, and we put them together. But the bottom line is that this is not making taxes any simpler. I mean, there's nobody out there. I think from Trump all the way down to, somebody like me on the outside, nobody's saying, "Oh, this makes things a lot easier." Like, no, it doesn't.
You know what? Tell me a little bit about these videos that you've done because you've alluded to them a little bit. I know that you flew into Vegas and sat down with Toby Mathis, which I would have loved to have been a fly on the wall, but I guess I would just get the videos. Um,
Yeah.
but two of the most brilliant tax strategists that I've ever met. With him, all the tax returns that he's done, all the tax returns you've done, and then your defense of people in court, which has really been your specialty, hasn't it?
My specialty, yeah, not Toby's.
Yeah, and
Yeah,
so
Toby's was more planning, more planning. And I think that, I mean, the interesting thing, Don, I've been working with him since '01, I think is when I met Toby. So, I mean, we go back, quite a bit. And we've worked together on a lot of clients, or maybe he has a case and I got to take it to tax court or something, whatever. But a couple years ago, Toby came to me and he said, "Well, why don't we just put our stuff together and just sit down and do all these great videos?" And people would have then a resource where they could say, "I don't really understand what I need to do to capture my auto miles." And they can just go and there's a 7-minute video on that, or 10 minutes, or whatever it happens to be. But I've been down there several times to record a lot of videos. And again, when we have a new tax law like this, I'm going to go again. And the only bad thing I can say about it is I've got to be in Vegas then sometime in July or August. And so that doesn't do, I don't do well in 115 degrees, but thankfully the recording studio has air conditioning, and basically it's just a way that it's hard sometimes to either, every time you talk to your tax professional, if you have one, it's $500 or $1,000, and it just costs a lot of money. And a lot of times you could get the information you needed by yourself if you had the source. And that's all we've done is just become that source.
and we'll be talking about this, those videos during the next summit, and be offering those. And so, what an opportunity! I'm looking forward to watching the videos. Okay, does small business stock plan mean you can deduct buy trade small cap stocks?
No, no, no. We're not. Yeah, we're not talking about small caps or anything like that.
Yeah.
We're talking mainly about, and I see where the question is there, because when you get into a small cap, you could have a market value, or way less than 50 million, right? You could, the penny stocks, so to speak. So you could have a 10 million, but it has to do with original issue stocks. You have to be there at the beginning, And then there's also limits on the number of shareholders. Now it's not a hundred like it is with the S corps. I don't recall what the number is, but typically you're going to be involved more as a passive investor with some business that you have some knowledge about, as opposed to something that's just on one of the stock exchanges.
Okay, right. So, for example, Kendall and I started Protect Wealth Academy. We worked for other companies, but we started this 13 years ago as a C corporation. If we go to sell the corporation, we can be exempt because depending on the industry that we're in, and we're not in a service industry, we're in education, we can be exempt from paying capital gains taxes on the sale of our business
Yep. And
because
and
we're
and
the
that's
owners.
yeah, and the whole purpose of that is that the government wants people to invest in small businesses, right?
Right.
And so if you've got, and I'm not talking necessarily about a small business like, I just retired yesterday and I'm going to work, a couple hours a week at this small business. I mean, we're talking about, a business. I've had many clients where they'll start a business with maybe 1 or 2 million of capital, and the next thing two, 3, 4 years have passed, and now that business is doing 50, $100 million of revenue every year. And so now that, maybe that $50,000 investment that I threw in at the beginning, I could cash out for a couple mil and I'd be looking at a big tax bill. But with this small business stock, it saves me. So it basically, I think there's it's more of a risk, right? If I invest in Don and Kendall's company versus I invest in Microsoft, presumably your company is going to be a higher risk, right? And so we get this higher
Sure.
reward when we cash out. But a lot of planners
Okay.
don't know that.
There's a comment here. It looks like poor people will be the big losers. And let me rephrase that. It's because I don't think that's true. I think people without a business are the big losers. Is that fair to say?
Yeah, yeah, I think that is fair to say. I mean, I think if you made $1 million as a W-2 employee, how much of this tax bill is really going to benefit you? Maybe the salt
Yeah.
cap, maybe, I mean, you're going to probably get a benefit out of it. But if you gave up that $1 million W-2 job and went into a business and made that same $1 million, that's where the sweet spot is, right?
I
So,
think real estate investors are going to get the and business owners and so if you want to benefit from it, have a business of whatever kind it is, sole proprietorship, S corp, C corp, LLC taxes. That's where the tax benefits are, and I believe that that's where the focus of this bill is for business owners and investors.
yeah, yeah, it absolutely is on that. And I think too that you'll see I didn't talk about real estate investors or whatever, other than maybe some of the credits on the green energy sort of stuff. But do you think, does anybody really think that Trump is going to sign a bill that makes it worse for real estate investors? Right? I mean, if you look at
Yeah.
where a lot of the Trump money and assets and everything is, it's in real estate, right? His buildings, his golf courses, his whatever. I don't know what he invests in, but they're all real estate backed. And I know when he was going back in 15, the first time when he was running, and he was talking about all these tax provisions and everything. It's like, yes, real estate can generate some really nice tax provisions, and he's not going to kill those. And neither is the Republican Congress. So I don't see the real estate investors really getting hurt in any way. And maybe we'll even get some benefits out of it when we see the final bill.
Yeah, great. Okay, we only have a few minutes left. I promise Scott that I won't keep him forever and ever and ever. Now, you're getting some nice little thank yous and wonderful news, and thank you for those. How high are capital gains from foreign property, plot of land? How would that be treated?
Well, your capital gains on foreign property. So I got a piece of real estate up in Canada and I sell it. What happens then is that whatever the taxes are in Canada control that particular transaction. I also have to report that on my US tax return, but I get a tax credit for whatever I paid to Canada. So if I would have owed $100 to the US, but I paid 200 to Canada, I don't have to pay the United States with a foreign tax credit.
Okay. And Vanny, we talked about solar credits and EVs, and they're still in place for 2025. And that might, and Scott mentioned that they might extend to 2028 or so, we don't know. But right now, they're valid, and so he mentioned now might be a good if you're going to buy an EV, might be a good time to do it.
I
Any
definitely,
comments?
yeah, definitely agree with you on that. You know, that if I was going to buy an EV right now, I mean, there's two different tiers. There's one tier where it'd be like the Teslas where they've sold more than a couple 100,000 vehicles. But if they're sold less than 200,000, the credit is still going to keep going into 2026. But what I would do here if I was going to buy an EV is I'd figure out, okay, what do I want to buy? Let's say it's a Tesla, then I'd research and see if I buy this $50,000 Tesla, what are my tax benefits? Versus what if I go and I buy a $50,000 EV from some other manufacturer? There may be different tax benefits there. So it sounds weird, but the bigger the manufacturer is, the worse the credits are for you as an individual.
Great. I'm going through and looking at some of the questions. It's not too late for QBI right now. It's still in effect, and it looks like it will continue. Um, we already
Yeah,
talked about
I think it
that.
will, Don. You know, one
Yeah.
quick point on that though is if somebody didn't know about QBI and found out about it tonight, you can go back a couple years and amend your tax return, claim the QBI if you qualified for it, and get a refund back. So again, if you learned something tonight that you didn't know about and you could have used it last year, look at, I mean, see, is this something you really spent the money on? And let's amend the return because I'm always telling people you got to amend the return if you missed income, right? You got to get it right. But it goes the other way too. If you miss deductions, you can get the money back.
Great. No changes on long-term capital gains. I didn't see any changes on that.
Nope.
Okay. And we did talk about taxes on tips, and so go back and watch the recording on that. Um, it just in real quick summary, it looks like there'll be a phase out. Where that phase out is going to be is being determined between that House and Senate. Is that pretty much
Yeah,
it?
the tips and the same thing with overtime and stuff. I mean, there's going to be two phase outs. One is it's going to be on your income, so they're not going to let somebody with make $1 million a year claim these deductions. But the other one is how much of it are you going to be able to claim? So like the House says, tips and overtime up to 25,000. So if you made 50,000, you'd only get to claim half of it. So we got to watch both of those phase outs to see kind of how that plays out.
And the 10,000 made in America auto deduction, it doesn't matter if you finance it or if you pay cash.
Right.
Oh,
No, it's an interest deduction, so you'd have to finance it.
oh, you
So
would.
yeah, yeah, because it's an interest
Ah,
automobile interest deduction that is not permitted today. So if you paid cash for it, you
oh,
wouldn't
that's
have the
right.
interest.
It's interest.
Hmm.
Okay.
So yeah, so
So
it's only
don't pay
financing.
cash, pay interest.
Yeah, well, and it wouldn't work for a lease either, I guess. It would be a purchase of a vehicle that you're financing as opposed to one
Okay.
that you pay cash for or lease.
Students, we've kept Scott a little over time. And thank you for the thank yous. We appreciate that. Scott, we will see you in the future.
Absolutely.
Sometimes he's on the summit. We often have him during the webinars, whatever. Scott, thank you for being available for this and answering so many questions. We so appreciate your expertise. And students, watch for those videos that are going to be coming out. We'll talk about them during the summit and give you an opportunity for a discount on those. This is Scott and Toby talking taxes, and with more clarity than I'm excited to watch these. Any closing comments, Scott?
Oh, Don, just again, like everything else, tax planning, you got to do it. Nobody wants to do it, but you have to do it if you want to, keep your bills down here. And so I just want to thank everybody for giving me an hour and a half of your time tonight or on the re-listen down in the future. And just, remember that, 200 people, 500 people, 1,000, whatever it was on this call tonight. we've got 200 or 500 or 1,000 different tax plans. So we're all unique, but get that so that you can keep more of your money for yourself and your family. So thank you for listening. Thank you, Don, and we'll see everybody soon.
Scott, thank you. We will see you at a nearby summit coming up, or watch our webinars for Scott to be here in the future. Everyone, thank you. Have a great night. Bye bye.